All right, well, we're going to turn our focus now to emerging market equities. They saw their third worst sell-off in early August since 1988. And Geoffrey Dennis is global emerging market strategist at Citigroup. He says these stocks have already priced in a great deal of bad news and are at a buy at these levels. Jeff joins us now with more. Jeff, good to have you on Fast Forward as always. Thanks for joining us.
Thank you.
You know, we've had a number of analysts and strategists who've been bullish on emerging markets, and it has yet to really play out. Only really in August have we sort of seen, Brazil in particular, that's a big focus, do a little bit better, actually picking up. So why is this all going to turn around now?
Well, I think certainly you're right. A lot of us have been far too constructive, and that's absolutely true with me. We've been too bullish. I think what we're really saying now is that prices have come down such a long way that unless there really is a catastrophic economic outlook developing now in the world economy overall, particularly in the developed markets, emerging market equities are now cheap enough that we should be able to look through what could be some more short-term uncertainty and look for better opportunities or better market performance down the road. In other words, through all of this, as your previous reference to emerging market debt really emphasized, we're seeing pretty good fundamentals in emerging markets. We're not seeing the economies come under extreme pressure. Certainly there's some downgrades, and we would expect that. But China's looking pretty good still. The Indian economy is looking pretty good. And therefore, unless there's really something very bad coming down the pike in terms of developed market economies, we think that at this sort of level, a lot of this stuff is now priced in.
Well, that is a big debate, though. What is happening in developed economies, right? Clearly, we've been focused on Europe. The U.S. is of concern. A lot of debate today over whether or not the Fed will have to intervene or will intervene once again before year end with another quantitative easing program. Are you just more optimistic about what happens in the U.S., or do you believe that the emerging market countries their fate isn't completely hinged upon what happens in developing nations?
It's a bit of both, to be honest. Our economists are telling us that there shouldn't be a recession in the U.S. I think the challenge for markets generally, and certainly for emerging, is that you've got to believe in the very short term there could be some more softer U.S. economic data. We've got to get through that period of time in terms of the data when the markets weaken dramatically around the debt ceiling episode and the concerns about default and then, of course, the downgrade. So there may well be some more weak economic data to come, which could lead to more concern within the markets about that. But if you get through that period without us collapsing into recession, again, there's not the view that there will be a recession, markets should eventually start to stabilize. But it is partly that emerging market economies are doing better. I mean, I've always had the view that emerging market economies can decouple, markets can't decouple. There's no way we'll decouple from global equities. But through all of this, as indeed, to be fair, happened in 08 and 09, some of these economies will hold up relatively well. And once you get through the worst of the U.S. environment, I think that should allow these markets to recover.
Now, you like China, you still like China, Korea, and Russia. The one name that seems to have fallen off the list, and I just want to make sure we're not missing it, is Brazil.
No, you're not missing it. We actually downgraded Brazil to neutral again at the beginning of July, not particularly because I saw a big sell-off coming of the sort that we had, although that has happened, but more because we were uncertain in the middle of the year about exactly how much more interest rates may have to rise, how much more inflation could go up. Now, as you look down the road, of course, very importantly for all emerging markets, not just Brazil, the risk of interest rate increases from here has been essentially removed. We don't expect China to raise rates anymore, nor India, nor Brazil over the rest of this year. And that should also help the asset class overall. So Brazil, I think, is in a slightly better place vis-a-vis monetary policy now. I think investors' concern about Brazil is how much might the economy be slowing down. I think that's something we still have to look at.
Right, Jeff. We have to leave it there, unfortunately, but that does seem to be the question now. Has the pendulum perhaps swung too far the other
Definitely.
way?
I think so.
Gives a sense of just how skittish all investors are at the moment. All right, Jeff, always a pleasure to have you. Thanks so much for joining us. That was Geoffrey Dennis, Global Emerging Market Strategist at Citigroup.